This is Medical Properties Trust Q3 2021 earnings call summary. This one was pretty short and sweet, but I did want to bring up something that I thought was interesting. They mentioned early in the call that they won some sort of award for being best company or something or other. And um, while it is true that um, happy employees do um, usually mean that management is doing a good job, with managing their workforce, and that typically bodes well for profit and also revenue generation because if employees are happy, they tend to work harder, they tend to make more money, and you tend to lose less money, right, over time. Anyway, that's the theory. So the minute I saw that, I immediately went out to Glassdoor, which is a typical site that I use to evaluate how companies are treating their employees. And um, I dug as much as I could dig, and I didn't find anything at all for Medical Properties Trust. This is their Glassdoor page, and there's nothing here. I am a little concerned though because this says that their headquarters is in, I think this is Iowa or Idaho, Iowa. Um, and I know the company to be headquartered in Alabama. So, um, not quite sure what's going on there, but I've had many jobs in the past and they give you these surveys, and when you're dealing with a small company, um, the idea that your survey results are going to be anonymous is sort of laughable, right? And no one really wants to rock the boat too much. Imagine if every one of your 50 employees gives you a bad review on a third party survey. I mean, Monday morning is going to be weird, right? I mean, and I don't think a lot of people want that. And so typically, you just, kind of, I'm not going to say lie, but you're not as forward as you will be with a larger company where your anonymity is more secured. With that being said, no one has gone out to Glassdoor and reviewed this company at all. So I'm not going to even think about whatever that award was, even though they touted it, right, as, we're the best this, but and for me, doesn't mean anything, especially when that information is not public. Okay. The other thing I did is I went out to LinkedIn, and I did find the company page here, and as well as a lot of their employees and head guys and managers and stuff like that. And again, there's no real reviews here. But I do want to point out, though, that using something like LinkedIn is a good way to get inside information about a company, right? I mean, just kind of go down the list and you find someone that's kind of cool, or maybe someone that's in a particular department that may have some information concerning, whatever you're looking for, right? Now, legally, the employees cannot give inside information. You, as an investor, cannot use inside information to profit in the market. But again, the information is there. Conversations do happen, right? And so this is just one of the ways in which that works. And I just wanted to point that out because, again, when companies talk about we're the best this, we're the best that, you want to go and you want to find that public information to see if it's even true. And again, like I said, great management who treat their employees good typically mean good business and good profits. The executives mentioned in the call that their current return on their properties are in the neighborhood of 5 to 7%, which is not bad. The issue that I have, and I've stated this before, is that when rates rise, what that means is that their return is going to get smaller and smaller relative to the risk-free rate. Okay, now the risk-free rate is what we talk about when we talk about interest rates. Okay, so let's just say, all right, let's just say that the U.S. government has moved U.S. debt to 2%, meaning that you can put your money in U.S. debt, whether it be treasuries or bonds or what have you, and you can gain 2% interest on that money. Now, technically, we call that risk-free money because we don't expect the U.S. government to default on the debt. This is, worldwide facts, right? The U.S. is the world's currency, and so many countries buy U.S. treasuries and U.S. bonds and U.S. debt, right? And they earn that risk-free rate. So what happens is, let's say the U.S. government now let's say you're getting 5% return on your money, okay, with the company. Now 5% compared to 2% sounds like a great deal, and so of course you'll invest your money with the company giving you 5% versus with the U.S. government giving you 2%. What happens though when the U.S. government raises that to 4%? Now it's not going to 4% anytime soon, but let's just say the U.S. government now raises interest to 4%. Now all of a sudden that 5% that you're getting from this company doesn't seem as great of a deal, and so you're less likely to invest with the company than with the risk-free U.S. government. Because remember, the company that you're investing in is not risk-free. There's risk involved with investing in that company. The stock price can fall, anything can happen. And so that is what concerns me. That is kind of what I'm looking out for and looking forward to. Don't quite know what's going to happen and how it's going to happen, but currently 5 to 7%, not a bad deal at all. They also mentioned that a lot of their contracts, of course, is, and I want to say the actual number. They say that half of their contracts, half of their leases are based on CPI, which is inflation. Okay, and so as inflation rises, which it is, those lease agreements, right, the rents that the hospitals pay every month are going to rise with inflation. However, half of those leases have rate ceilings, meaning that it will never rise above a certain amount. Now, what that amount is, I don't know. We'll really have to dig down to figure that out. At this point, what we know is that there is a limit to how much those rents can be increased. So even if inflation goes to, let's say, 9%, right, the lease will not increase to 9%. It's probably capped at something like 4% or something like that, right? That's a problem because what Medical Properties Trust does is they borrow money, okay, at an interest rate, whether that interest rate is 2%, 3%, 4%, whatever. They borrow the money at that rate, and then they purchase the hospital, and then they lease the hospital to the operator who is running the hospital. Okay, so if the operator who's running the hospital, if inflation goes to, let's say, 9%, right, that means that it's going to cost Medical Properties Trust 9% to borrow money. Okay, but they can't raise their rents to 9%. That's a problem. All right. Now, again, these are arbitrary numbers I'm just throwing around here. Keep in mind, this is all relative. Okay. And so what I mean is that when rates rise relative to what Medical Properties Trust has contracted for and relative to what Medical Properties Trust is getting money at, right, what their loan rates are, is going to determine whether or not it's a good investment. And if it's deemed not a good investment, people will sell the stock, they'll stop buying it, and the stock price will fall. Okay. The other thing they mentioned is that they are currently still doing deals. They've done so far about $4 billion in deals this year, meaning that they've gone out and they've purchased $4 billion worth of properties. They're also selling properties as well, but they're not selling anywhere near $4 billion of properties a year. Matter of fact, they just sold some properties in Germany for a paltry 20 million, right? 20 million is a lot of money, but compared to um, the money that they're paying for properties, 20 million is nothing. Um, the other thing that they mentioned, and this does not involve all of their properties, but they do have options on the table that if they want to, they can sell the property back to the operator at a profit, which is really interesting because that means that if Medical Properties Trust deems that this 5%, this 6% they're getting on this property doesn't cover their loans, right? Then they can say, you know what, guys, nah, we're done. We want to sell this back to you, and the operator is required to purchase the property from Medical Properties Trust at a profit. What that profit is, we don't know. They won't disclose it, but it is more than what they paid for it. Also, too, there's always, in almost every case, um, a clause in the lease that says that when the lease is finished, the operator has the option to either resign the lease or purchase the property back from Medical Properties Trust. And so, um, the more that they can do deals like that, the better, because what it does is it allows Medical Properties Trust to get out of a bad deal when those rates do increase. Because, like I said, that's what we're looking at right now. It's rates increasing, and so that 5 to 7% may not be a good deal in the future. Um, the other thing to mention in that regard is the oh shoot, buying back properties, selling properties. Oh yeah, so they have continually diversified the operators in which they work with. In the past, what, like 2 years, um, most of their properties were operated by Stewart, and so that was always an issue. It was always something that was talked about in the investing circles, stock market circles, whatever. Because the thing is, if half of your properties are operated by Stewart, let's say Stewart goes bankrupt, well, all of a sudden you're missing out on half your income, like automatically. And so, what Medical Properties Trust has done over the past 2 years is to divest those properties away from Stewart, and doing deals with other operators. So that's really good. As of right now, they got it down to 18%. So 18% of their properties are still operated by Stewart. The rest of the properties, I think, at the most, are like 5% operated by other operators. So there may be, 4 or 5 different operators, but they don't have anything more than 5% of the total property portfolio, and they are continuing to divest away from Stewart as well. And they mentioned that they've been doing this for a while. There was another company that they had a similar situation with years ago, and they were able to get them down to about 3% today. So I do expect them to continually divest away from Stewart, which can only be a good thing. You definitely want to diversify and make sure that you are spreading your risk. All right, I do want to touch on. I talked about employees and having your employees work hard and do well, generate revenue, and typically when that happens, you're supposed to save money, right? Now, my thinking is this, all right? Medical's Property Trust, again, all they do is they borrow money, they buy hospitals, and then they lease them out, okay, and they know how much their profit is going to be, roughly, based on the lease agreement. They said it, 5 to 7%. It's kind of written in stone, right? So management comes from all those other expenses, and that's what we're looking at right now. Okay, so we see interest, real estate depreciation, which we're not going to include, property related expenses. Now, most of their leases, the operators are the ones who take care of maintenance and stuff like that. But of course, Medical Properties Trust owns the properties, and so there's still some property related expenses there that they need to take care of. But it's really nice that, for the most part, most of the operators take care of building maintenance. And then we have general and administrative. And so that's going to be your employees. Okay. That's going to be all your secretaries, all your accountants, all that stuff, right? And then acquisition costs. That's just whatever expenses you had to pay in order to purchase these properties, whether it be attorneys, whether it be permits, whatever, right? So what I want to do is I want to see what their performance has been over the past couple of years to see if it's improved or if it's gotten worse. Okay, so I'm going to start with 2015 here, and I'm just going to put in 299,524, and I'm going to take out the depreciation and amortization. And again, the reason why I'm doing that is because it's not a real cash dollar expense, right? And again, like I said before, in a lot of these cases, the operator has to purchase the property back from Medical Properties Trust at a profit. So I'm going to take that out. Let's see. 867. All right, and they're going to divide that by the total revenue, 441,878. And so that gives me 52% in 2015. Let's see if that increases or goes up in 2016. See, so 48% in 2016. So it's come down. So let's see now if there is a trend happening here. So 2017, got a lot of depreciation there, but the revenues are way up. What that tells me is they obviously purchased a building or something, bring in more money. And so again, we see 38%. And I apologize. What that means is it's coming down. So that's actually a good thing. So 52% in 15, 40% in 16, and now 38% of total revenues is expenses. So it's coming down. So that's good. Let's continue with 2018 to see what's happening here. 133, 083. Divide that. 4522. 40%. So it came up just a little bit. And now let's do 2019. 52,313 divided by 854,197. 42%. So it looks like it's trending up, which is not a good thing. It's not a good thing, right? We started off at 52% back in 2015. Got all the way down to 38%. Now we're back up to 42%. And that's 2019. Let's take a look at where we are currently. Did I have that queued up? I don't. Okay, no worries. Well, either way, we see right away again is going up. So again, that's management, right? That's management. Getting the lease signed, making sure that all your I's are dotted and your T's are crossed. That's one thing. That's the business. But then management has to come in and really keep an eye on those expenses and keep them under control. And it looks like, at least over the last 3 or 4 years, it looks like those expenses have been creeping up. And so That's not a great thing, right? It's not a great thing. We definitely want to see those expenses come down. I'm sorry I don't have the current quarter queued up, but I have to imagine that it's probably up and down. But again, looks like it's trending up, um, which makes me really disbelieve that whole, independent third party survey of our employees. I don't believe it at all. Here's the other thing that I wanted to go through in the call, and man, I hate when guys do this. In the call, the executive mentioned that, oh, we're getting these great loan rates. We have a lot of business over in Europe, and so we're getting really cheap rates over in Europe. And then I come and I look at their actual presentation that they put together, public information that they put out, right? And I'm looking at their rates, and I mean, yeah, for sure. The 1% here at the top, but it's variable. It's variable, meaning that rate can go up. And I'm pretty sure that rate is going to go up based on inflation. And we're currently looking at inflation, meaning that rate is probably going to go up. So yeah, it's a decent rate, but then look at the amounts. That's only Now I'm not going to try to do the math on this, but I think that's $1 billion. I think, because I think we're looking at 650 million here, and so when you add the 200, 200, and 650, it's about $1 billion at these great rates. But the rest of these rates, we got a couple of twos, but 4%, 3%, 5%, 5%, 4.6, 3.7, and this one is the big one, right? This is, I think, 1.4 trillion at 5%. 5%. So understand this: you're getting a loan at 5%, and you're going to purchase a building and then lease it out, and you expect to make 5% back on that lease. It's not making a whole lot of money. And like I said before, as we see rates increase, that is going to look less and less desirable. So weighted average, and again, this is their numbers that they put out, 3.3%, which is not horrible. It's really not. If Joe Schmo went out to Ford and wanted to buy a new car, um, well, not a new car, let's say a used car, right? You can expect to pay, 3 to 4% interest. Um, so not horrible, but definitely not the less than 1% that he was touting on the call. So anyway, my thoughts on medical properties trust is that it's a good business. Hospitals aren't going anywhere anytime soon, unless we see a real like Armageddon type economic turn down. Hospitals will be able to pay their bills primarily because they're subsidized through their governments, and this is most of the world, right? So I do believe that the income is stable, but I do worry that as rates increase, that investment in medical properties trust is going to look less desirable. The other thing to mention here in closing, in the past, medical properties trust has used equity. Um, I want to say distribution, but they've sold shares in order to get money to purchase these properties. And they mentioned in the call that that's not something that they're looking to do, but it is an option. Okay. Now, I've talked about this before, specifically when valuating companies based on earnings per share and things of that nature. Typically, companies don't issue shares. The reason why is because when you issue shares, you are making the current shares less valuable. It's as simple as if we have 100 shares of a company valued at $1 each, the company is worth $100. Real simple, right? But if I turn around and say, okay, well now I'm going to sell 100 more shares, right, at $1 each. Now you have the same. I'm sorry, you have double the shares, but now they're worth half as much. They're worth half as much. Now the company, on the other hand, they've made $100 extra, okay, because they sold 100 shares at $1, but now there's 200 shares controlling the same assets, right? And so it's up to the company to then use that money to make sure that they make money with their money. But that doesn't always happen. And regardless of any of that, right? When a company issues shares, the share price falls just across the board. I'm sure there's some exceptions, but for the most part, when a company issues shares, share price falls. And so we don't want to see medical property trusts issue shares. We definitely rather them go to the banks and get loans and things of that nature. We much rather them issue debt and stuff like that. But I mean, like I said, there's some real risk. There's some real risk here, and so currently I think we're up just a little bit on this position. Definitely going to watch it very closely, and any sign of any weird stuff, we definitely want to get out.